Hey, good afternoon, everyone. Welcome to today's webinar, Q1 Earnings Sneak Preview. It's Monday, April 18th. You got John Hopkins here. Tom Bowley gonna join us in just a minute. Hey, if you're new to EarningsBeats, I want to really welcome you and thank you for taking the time to stop by today. I think you're gonna find this to be an extremely informative session, considering the thousands of earnings that'll be coming out over the next several weeks. This is a time when you should be paying attention to what's going on with companies out there. Also, of course, our seasoned veterans, many of you have been with us for many years. Thanks so much for stopping by tonight. We always appreciate your support. All of our webinars are recorded, so we'll make sure you get a copy. For some reason, you can't stick around for the entire event, no problem at all. We'll make sure you get a copy plus any attachments that might come with it. Now tonight is what we call an open event, which is available to all members of our EarningsBeats community, the stock charts community. On the other hand, tomorrow night, we've got our ETF model portfolio event, which is a member only, subscriber only event. And then a week from Wednesday, there will be the follow-up to this meeting. So this will be fairly abbreviated tonight, but by next Wednesday, we'll have a bunch of companies that have reported, plus many more that will be coming out that Tom will be talking about that will also be a members only. So if you are new to EarningsBeats, you're not a trial member, you can sign up for absolutely zero, get a 30-day trial. You'll be able to participate not only in tonight's event, tomorrow, and a week from Wednesday, very timely, and hopefully you will consider that. Plus you'll be getting, of course, Tom's daily market report and so much more, access to all of our chart lists, just a ton of information that we think you'd find very useful. Anyways, I know Tom's got some stuff to cover tonight. Let's make sure he's in the house. How's it going, Tom?
It's going well. Excuse me. Going well. How are you doing, John?
You there? I can hear you.
I'm here.
Yeah, I'm glad. Otherwise, I got to really scramble to get something together.
Yeah, I don't think you're going to be ready for this.
All right. So listen, I'm going to go ahead and step aside and let you get rolling here.
Yeah, it's going to be, I'll try to do this as quickly as possible, but there is a lot of information I want to go over. I want to make sure, especially those of you who are in our EarningsBeats Digest community, if you're new, I want to make sure you're aware of these upcoming earnings chart lists that we do, because I think it's a really cool added benefit to follow along during earnings season and just to stay organized, knowing what's coming up and the likelihood that certain companies will report better than expected or worse than expected results. I think that relative strength gives us a lot of clues there. So let's go ahead and pull up the agenda for tonight, and we'll go ahead and get this thing started. So far, we do have early results in from, I would say more than just a few companies. Probably a solid, 40 or 50 companies have reported. So I wanted to go through and just share with you some of the highlights. A couple of the companies that I think reported really nice numbers, other companies that not so much. Then we're going to get into relative strength, sectors and industries. I think this is really important as you go into earnings season as far as your expectations. Wall Street has been rotating into certain areas and out of certain areas. And by following that relative strength and that rotation, I think you get a little bit of a leg up over a lot of the folks following the market in terms of how some of these earnings reports might surface, and just to be prepared, to be looking for certain things that might trigger a trade. You might be watching a company that's showing excellent relative strength. They come out with great numbers. They gap up. You don't want to chase, but you might have certain levels in mind. You might be looking for a pullback to say the 20-day EMA, or if there's a negative divergence, maybe even we get all the way back to the 50-day. But a lot of folks write these companies off and think, oh, they've reported and their reaction's bad, therefore I better stay away, when in fact, a lot of times those are some of the best setups. So the whole idea tonight is just to prep you a little bit for what we're going to be doing next week, where we take a look at a lot more companies heading into earnings season. And so this is what we call our sneak preview of Q1 earnings. So talk a little bit about a few companies that have reported, talk about some of the companies that will be reporting this week. There's like 135 companies that I've got and that I'm following on our upcoming earnings relative strength chart list. And, that this is just literally the start of earnings season. We're going to have thousands of companies reporting over the next several weeks, mostly over the next 3 to 4 weeks. And we want to make sure that all of our folks at EarningsBeats are ready and prepared for it. Then we'll get into some of the predictions. So looking ahead in this week ahead, we've got 135 companies. Which ones look like they're likely to report strong earnings? Which ones weak earnings? I'm going to go through all that with you as well. So that's the agenda for tonight. So let's jump in. I'm going to go ahead and start off with some of the early earnings highlights. And for that, I want to start off with Delta Airlines. So let's go ahead and pull it up. I'm just going to talk about the reactions. I'm not going to go through and talk about all the fundamental data that came out, what the numbers were and all that. I mean, we'll be here all night. I don't think everybody wants to get into that, but I want to just talk about companies that beat in general, what their charts look like. And when you look at Delta Airlines, first of all, one thing that strikes me is that it just went to a new 52-week high relative to its airline peers. So while overall airlines are just kind of going sideways relative to the S&P 500, Delta has become a leader. And so if the airlines, start to perform really well, here's the airline chart right here. So it's still what I would say is in a downtrend. We're putting in lower lows, lower highs. It's kind of like here we went down, we rallied, but we couldn't get above the prior high. Here was a prior high. We came down, we rallied, but we haven't been able to get through this prior high. This is what I would be looking for in terms of airlines. If we could get through 200 or maybe 202, then I think Delta Airlines becomes more viable as a trade because it is one of the leaders in the group, but we need to see the group showing just a little bit more strength. But this is one to watch. I thought Delta had a pretty good report. Now, again, if you look at the numbers, you might say, what do you mean they lost a ton of money? Yeah, they lost money, but they lost less than what the market was expecting. And we're seeing money rotating in on a relative basis into the group. And also the volume has been pretty heavy supporting this move, the upside. So there are definitely some positives here with Delta. And so the bigger question for me is just whether or not airlines get going. So I thought Delta was pretty good. UNH, this is probably one of my favorites so far. I thought UNH had a great report. I'm waiting on it. This is one of those that it was kind of a buy on rumor, sell on news kind of stock heading into earnings. I think Wall Street was expecting big numbers. They got the big numbers. They beat on the top line. They beat on the bottom line. When I say top and bottom line, I'm talking about revenues, top line, earnings, their bottom line. They beat Wall Street estimates on both of those. And you can see right here, we were making the breakout intraday. And then all of a sudden some selling came in. Healthcare has been taking a little bit of a back seat, a little profit taking. And so UNH has pulled back. But I think this breakout level right here, just above 520, you got the 20-day moving average coming in at 522. This is one that if it pulls back another couple percent, I think could be setting up for a nice trade. So it's not one that I'm rushing into, but I've taken notice. Great report, great area of the market. Healthcare, not only has it been performing well, but healthcare, 3 of the best months of the year, historically, seasonally for healthcare, May, June, and July. And here we are in the second half of April, getting ready to head into that seasonal period. So you want to be aware of some of these companies within that space that have been reporting strong numbers and potentially could see some additional breakouts in the months ahead. So I really like UNH. One last one that I think reported this morning really strong was Bank of America. BAC, nice reversing candle, by the way, off this downtrend. That's a bullish engulfing candle. Right near this support level, it looked like we were breaking down on Thursday, gap down this morning, but then we rallied back. So in the short term, I kind of like Bank of America. From a technical perspective, relative to the banks, watch this area right in here. You'll see this low, this low, this low, and then Thursday's low. All of these 4 relative lows are pretty close. If we were to fall back and Bank of America starts to underperform its peers and breaks those lows, then I'd probably ignore what I just saw in terms of earnings. But as long as the relative strength stays pretty good here, if banks rally, I would expect Bank of America to do pretty well coming off of that. So initially, I think we'll probably see Bank of America go up and test its 20-day, and then we'll see what happens from there. But Bank of America, I thought, had a pretty good report relative to some of its peers. We saw JP Morgan. I'm going to give you some disappointing ones. I'll start off with JP Morgan. AD line, horrible. Look at the relative strength on JP Morgan. Just a month ago, it was at a 52-week low. It came out with earnings and started moving lower again relative to banks. Now today, rising tide lifts all boats. So they're, as far as the banks go, banks had a good day. JP Morgan went up, but in terms of relative strength, we still got issues with JP Morgan. I still think we're in this downtrend. So JP Morgan, they missed on their estimate. Their earnings came up short of estimates. They're already underperforming. Their AD line is weak. I would be careful. This is one that if I was going to short a bank, which I'm probably not going to, but if I was going to, JP Morgan would probably be one of those at the top of my list. It's just not a very strong stock right now within this space. And they did just miss. KMX. This is CarMax. They came out actually right before JP Morgan. I think it was last Tuesday. So before the bank started reporting, but you can see this move down right here, breaking to a new low. Look at the AD line. Look at the relative strength relative to specialty retailers. They missed their number, not looking good right now. So CarMax is one, I think, came in with a pretty awful report. Not very impressed there. And these are the types of companies that if they do see strength, maybe to their 20-day EMA, and I wanted to short, that's where I could maybe short without having to risk a whole lot. So that's what I'd be looking for on these downtrending stocks. Rite Aid, it was an ugly report. I think they were expecting, well, I'm not sure if they were expecting a profit. I know their numbers came in way below expectations. And when the news came out, we got a gap up. I think the stock was beaten up so badly. I mean, it was $15 beginning of the year, went down to $6 recently. So I think when the earnings came out, it was probably just a relief that it wasn't any worse than it was. We got a gap up, but notice it didn't last. We had another big red candle, heavy volume, over 25 million shares, a lot of distribution taking place. I think Rite Aid still looks very weak. And then today, Schwab came out. They missed. They had an ugly report. Stock gap down, looks a little bit like a hammer, but I'd be careful because they actually closed at a new low. They closed at their lowest level since all the way back at the beginning of October. So, and did so on 25 million shares, 24 million shares. So I would be really careful. The AD line has now broken to its lowest level since probably back in October as well. Relative strength, which wasn't that bad. This is actually a little bit of a curveball, I think, that Schwab threw Wall Street. I don't know if Wall Street was really anticipating as bad a report as what they saw. And look at that relative strength drop immediately, a big move down. Any kind of a bounce, I think, in Schwab probably could be shorted. All right, so those are the ones, at least from early accounts, with 10 or 5% of the precincts reporting. They always do that with the election night. Probably not even 5%. It's like 1%, less than 1% of precincts reporting. These were some of the stocks that I thought looked either good or bad. All right, so let's move now to relative strength. So I want to talk a little bit about sectors and industries, because going into earnings season, I want to know what's going on with sectors and industry groups on a relative basis all the time, but especially as we go into earnings season, because this is how Wall Street is really telling us what they're doing with their money. If you think that they're telling you on CNBC what they're doing, well, congratulations. I don't believe that at all. I don't trust anything I hear on CNBC. I trust what I see on the charts, though, because this is where the money's going. There's no point in putting a whole lot of money into a stock if you really don't like it. You know what I mean? The money is there for a reason. This is where they're placing their bets. So it's important to look at relative strength. So I'm going to go first. Let's start off with technology. technology, this is a chart of technology relative to the S&P 500 right here. Down below is the absolute chart. This is the price action in the XLK. This is the relative price action in the XLK versus the spider, or versus the S&P 500. Now, one thing I want you to note is that you notice down here, technology has not broken down below its February low, still holding on to its February low, but its relative strength versus the S&P is already broken down. And that kind of tells me that this is not going to hold. It's not a guarantee, but it just doesn't have a good look. Money is rotating away from technology. One thing that's holding up technology is just the fact that the stock market overall is still well off its lows from February. The S&P 500 was down near 4,100. Today it was what, 4,375 or something. I don't know exactly where we finished. So it's still got a long ways to go. And that's what's propping up the prices on technology. But if you look under the surface, Wall Street is selling technology. So actually, Aaron, are we okay? Are you there? Because I just got something that came up and said participants can now see my screen, but I thought I was sharing all along. Is there any problem?
You're okay. You've been sharing.
Okay. I just wanted to make sure that there wasn't something going on. Maybe it was just a Zoom malfunction there for a second. Okay. So my point here is that technology continues to underperform on a relative basis. This is not a good look. And we're probably going to test this relative support level down here from back in May. And while we're doing that, probably we're going to see a technology breakdown. And that's always worrisome because this is the leading area of the market. This is 28% of the S&P 500. If technology is not performing well on a relative basis, we should be worried. This is a risk on area of the market. So just know going into earnings season, Wall Street has been bailing from technology. So if you're sitting back expecting some big reports coming out of technology, well, Wall Street, based on their meetings with management teams, have gone back to their firms and decided to sell for themselves and for their clients. Now, unless they've just gotten bad information, which I would doubt, I'm not expecting a whole lot out of technology this quarter. And the earnings reports themselves may or may not be bad, but I'm a little concerned about guidance and what they're going to say about future revenues. Or, I mean, look at what the Fed's doing. Fed's raising rates. Fed's very hawkish. Look at the interest rates going higher. We still have inflation. We have the war. There are going to be concerns at some of these companies, and they're probably going to start laying out some of their dirty laundry when their earnings reports come out. At least, again, this is the story that Wall Street's telling me on the charts right now. As far as some of the other aggressive areas, consumer discretionary on a relative basis, we just set a new low not that long ago. We bounced off of it, but back in February, that was the lowest level we've seen in almost 2 years relative to the S&P 500. What's going on? I think we got some problems. How about communication services? Good gosh. On a relative basis, it's absolutely fallen apart. This is a 5-year chart here. We've moved to 5-year relative lows in communication services. Think broadcasting and entertainment. Think internet. Think media agencies. These are the companies and industry groups that make up communication services. So, yeah, not looking very good. Financials. Well, let's do industrials first. Industrials. Relative strength's been bad since last May. It's tried to pick things up, but not really. It's just been consolidating on an absolute basis. One thing to watch for, watch the XLI at 97.5. That's where that support came in. That's where we saw buyers come in at the beginning of March. So if we break down below that level, that would be a problem. Financials. Financials going sideways on a relative basis look like they're rolling over here on an absolute basis. Again, getting close to that early March low. We'll see whether or not we hold, but that's another level I'd be watching on the XLF down around 36. Meanwhile, Let's talk about some of the defensive areas. Look at healthcare on a relative basis. And even on an absolute basis, healthcare has moved higher. How about consumer staples? We said discretionary was at a 2-year low on a relative basis. Consumer staples on a relative basis at an 18-month high. So all the money is rotating from consumer discretionary to consumer staples. Why would that be? You know, if the economy was going to be strong, we would see money. I mean, Wall Street would be moving into discretionary stocks, not out of them. So what this is telling me is that Wall Street is anticipating more weakness ahead in consumer discretionary over the summer months. I mean, we can ignore it if we want. I don't think that would be very smart. How about real estate? Real estate making a breakout on a relative basis. So we got healthcare rising. We got consumer staples rising. Real estate's rising. And utilities are rising. Now, I'm going to go back. I want to show you something, because I think it was in Chart Watchers. Let's go back to, back at the beginning here. Right here, December 31st, before this all started, I talked about a very rough start to 2022 potentially coming. And one of the things I put in this article, I want you to see the leadership for the month of December. The month of December, consumer staples, real estate, utilities, and healthcare, the 4 groups that I just showed you are still leading the market to the upside. They were leading back in December. That was the warning sign. That was one of the warning signs that I wrote about. This is never good when the stock market is going up for these groups to lead. What that's telling us is that as we push to new highs, Wall Street is getting rid quietly behind the scenes. Now, what they were saying on CNBC, who knows? But under the surface of the market, you could see what was happening. Consumer discretionary, barely up during the month of December. Technology up 3%. Communication services 3%. Financials 3%. Industrials 5%. Meanwhile, healthcare 9%, utilities 9%, real estate and consumer staples over 10%. Do you see the rotation that's taking place, that took place? That's why, one of the reasons why I got so bearish back in December, before any of this started. You know, a lot of people now are talking about, oh, things are bad. Now I'm going to start calling for a bear market. Well, my gosh, the market's already been beaten up. It's probably going to go lower, but it's been beaten up. And on this next low, everybody's going to be jumping on board. Everybody's going to say, this is it, final straw. And that's when we're going to be buying at EarningsBeats, because we're going to get some signals where the market's going lower. And this right here is going to flip. And we're going to start to see some of these aggressive groups begin to lead in a down market. And that's going to be a very, very bullish signal. But we got to wait. We have to have patience. We can't will it to happen. We have to wait for it to happen. It's not happening right now. Here, like I said, utilities, all the defensive groups since the beginning of the year. And here was December right here, by the way. Here was November on a relative basis for utilities. So let's go back and look at these from back at the beginning of the year. Here was real estate in December. We pulled back in January, but now we've broken back out to new highs. Consumer staples since middle part of November, straight up. Healthcare since the beginning of November, straight up. I mean, we've had some pullbacks on a relative basis, but we got a nice uptrend in place on a relative basis in all the defensive groups. So where do you think the money might go when these companies start reporting earnings? Because I think you're going to see utilities companies coming out with some pretty good numbers, at least relative to what we're going to be seeing in discretionary and in technology and communication services. And so I think we'll see continuing accumulation in these defensive areas. I don't know if the groups will go higher. I mean, when you look at healthcare, it looks like it's soaring. Well, it's soaring on a relative basis. You can see we did make a breakout above the December high, but we're already back down below it. It's not like healthcare is taking off. The difference is that healthcare is going up while discretionary and technology are getting killed. So the overall market itself is not going up, market's going down, but because healthcare is showing a little bit of strength, then that's where we're getting this relative strength from. All right. I'm going to keep moving on. I mean, we could talk energy and materials. Energy and materials to me are neutral. They can do well or do poorly in just about any kind of market. But aggressive areas of the market tend to do better in secular bull market advances, and defensive areas of the market tend to do better when the market consolidates and sells off. When it's just gone too far, too fast, and money starts rotating, that's a sign that we should be listening to, or a signal that we should be adhering to, and be prepared for what's to come. And I still think we have more weakness to come. I don't know if we're going to go below the February low. I'm beginning to think we probably will, especially with this money rotating back into all these defensive groups again. And we still have sentiment issues in the market. That tells me we probably need to break down just to right the ship. You've got to get sentiment reset to a point. Tonight's not about sentiment, so I don't really want to get into that. But we've got to see sentiment reset. We need to see money rotating back into the offensive groups below the surface. They're not going to announce it on CNBC, I can promise you. You're going to have to follow the charts. Stock charts lays it all out for us. All we have to do is set up our charts and just wait. Be patient, and it'll set up. All right, let's move on to the industry groups. Now, there are 104 industry groups. I'm not going to go through and talk about every one of these groups. What I can tell you is that the way we set up this chart list is we have all of the technology groups set up first. So there are 8 technology industry groups. So all of them are in order. I have 001 as XLK, and then I have them numbered 001 through 008. And we got computer services, semiconductors, software, and blah, 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 all the way down to renewable energy, which is our 8th group. And then I have 002, which is XLY. So we've got this format set up so that we have all the technology group together, all of the discretionary group together, communication services, industrials, financials, and all the way down. All of the different sectors, we have all the industry groups together. So one thing I can do is just quickly go through and just look at what is working, or in this case, not working with technology and consumer discretionary. So here's the 8 charts for technology, and just look at the relative strength on these. Computer hardware is pretty good. There's software. Software has just taken out the May low on a relative basis. Software on a relative basis now is all the way back where it was when we were just getting started with the pandemic. All of those relative gains in software have been lost in the last 5 or 6 months. The good news is software is going to bounce back in a big way, but we got to wait. You don't want to jump in while software is underperforming. It's too early. At least wait for it to get back up above its 20-day at a minimum, or a 20-week. This is a 20-week relative moving average. Remember, this is relative strength. It's not software by itself. This is software relative to the S&P 500. One of the best areas of the market, one of the leaders since 2013, software, and can't catch a bid right now on a relative basis. So I think you got to be careful going into earnings season. Wall Street's bailing heading into earnings season. Why should we be buying? Now, last quarter, what was happening is we saw companies come out and they would get initial gap ups in technology. Technology really was one of the best in terms of getting gap ups and then selling off all day. So as we go through earnings season, that's going to be a theme I'm going to be watching. Can we see accumulation throughout the day, or is it just a bump at the open and then selling off? Though that's a theme I'm going to be looking for throughout earnings season. So then electronic equipment. Look at this group. I mean, just absolutely falling apart. Computer hardware, Apple's group still hanging in. if this starts to roll over, this is going to be the last, what was that movie? Last of the Mohicans. My dad used to love that movie. I remember from many, many years ago. But anyway, this is going to be one of the last groups to roll over in the aggressive space. If it does in fact roll over, it hasn't yet. So this is one shining light. Electrical components and equipment just fallen, face first. Telecom started to strengthen in December. Now it's rolled over and it's back near a 18 or 17 month low. Renewable energy. I mean, we have these little pops. There was a little pop and then more selling. Here was a little pop. Now it looks like we're rolling back over again. Those are your technology groups. Did you see anything there that excited you other than maybe the fact that computer hardware is not getting killed? It's just kind of going along with the S&P 500. And by the way, down at the bottom is the actual price chart. So if we go back and we look at computer hardware, yeah, the relative strength is doing okay, but it is showing some weakness in its absolute price chart. It's just not losing ground to the S&P 500. So that's been I guess, an okay thing. I guess maybe a little bit of a positive, but we'll want to be careful if computer hardware goes back down and loses that early March low. All right. Next up, consumer discretionary. Again, I'm going to go through these really fast. Hotels looking pretty good. Hotels actually one of the areas, and you can see we're right up against absolute price resistance, just above 2,900. So let's see if hotels can make this a definitive breakout on their absolute chart. But right now, on a relative basis, they're looking pretty good. But outside of this group and maybe autos, I mean, I'm just going to flip through. I'm not going to go over each one, but just look at the down relative action on every one of these charts. Here, this is your welcome, folks. This is consumer discretionary. This is how much the stock market loves consumer discretionary right now. I mean, some of these over the last 4 or 5 months just been brutally beaten up. There's autos. So autos still trading above its 20, which is above its 50. Still got a PPO, relative PPO, that's above 0. But it's an exception. There's recreational products falling apart. Auto parts. Those are all of them. So all we had is hotels and autos. 18 out of 20 industry groups in the discretionary area are face planning right now. And that's Wall Street moving out of these groups. Again, why should we be excited about earnings reports coming up in technology and consumer discretionary if Wall Street's bailing on all of them heading into earnings? Don't expect a lot. Now, on the flip side, I could go in and let's talk a little bit about consumer staples. Now let's look at what the consumer staples groups are doing. Now, last 5 or 6 months, Brewers had a rough 2021, but on a relative basis, they're starting to show some strength. How about food products? Beautiful. How about soft drinks? Wonderful. Drug retailers, not looking bad. Personal products, not so good there. We are starting to bounce a little bit, but that's been overall downtrend. Non-durable household products, not bad coming off that October low. Then we got food retailers and wholesalers. They're on fire. This is one of the best groups in the market. And just a few more here. Tobacco coming off the low in November. Tires, actually tires have been moved. I haven't moved them yet in our chart list, but Stock Charts has moved tires from staples to discretionary, and they're looking like discretionary. Last 4 months have been horrible. And then the last one is the distillers and vintners, and you can see a recent breakout and uptrend there. So do you see the difference in our industry groups in the consumer space? Consumer spending is 2/3 of our GDP, roughly. And right now, Wall Street is betting on the consumer staples side. That, if you think we're in some kind of a great economic boom heading here over the next 3 to 6 months, I I think you might want to reconsider that based on these charts. That is not what these charts are telling me. But what I think is going to happen is we're going to have a very, very strong fourth quarter. And many of these areas of the market are going to bottom probably before that, maybe over the summer, maybe into late summer. September, October is when the market tends to find bottoms. So maybe it's going to, be a little rough another 3 to 6 months. We'll see. Anyhow, so as I go through and I look at these, this is how I start to prepare for earnings season. Because if I hold any stocks into earnings, it's probably going to be among the staples and the utilities. I'm not a big fan of holding stocks into earnings anyway. So what I normally do is I look for stocks that I think are going to report well. And then when they do, I just simply wait and hope I get a sell on the news. Come on back down, find a support area, and then that's where I'm going to jump in and trade. And on the flip side, if you like to short, let these technology companies and consumer discretionary companies, it's been a sell on the rumor. So when they come out with their news, if it's a buy on news and they get these moves to the upside, they go up and they test 20-day EMAs, that's when I would consider shorting. So depending on whether or not you like to short or whether you like to go long, just depends on which areas you want to look at. All right. So let's talk a little bit about the upcoming earnings chart lists. So I don't know if you are familiar with these. If you're new to our EarningsBeats digest, then you may not be aware. But when earnings season kicks into gear, we start putting together chart lists for our community. And these daily upcoming earnings chart lists that we do are free. If you're on the EB Digest, you'll see links in there where you can download these. If you have a Stock Charts account, Extra or Pro, that enables you to have hundreds of chart lists in your account. If you're a basic member at Stock Charts, I'm pretty sure you can only have one. I don't know if they changed that, but I know basic was only allowed at one default chart list. So if you try to download any of our chart lists, it's not going to allow you to, because you're only allowed one, which is your default. So you can't add any more. So if you're a basic, or if you're at a Stock Charts, if you're a non-member of Stock Charts, you can still look at all of our chart lists. You can pull up the charts one at a time. It's just not going to allow you to download into your account, because if you're a non-member, obviously you don't have an account. And if you're a basic member, you don't have the authority to download more than one. So if you're an Extra or a Pro member, again, you can download hundreds of chart lists. And so you can take our chart lists and download them. The beauty of these is that once you download them, you can view all. So right now, this is a chart list that had today's, all of today's companies that reported either this morning or that will be reporting this afternoon, or that may have just reported this afternoon. And starting next week, what we'll do is we'll break them down a little bit differently, like we did last quarter and the quarter before, where we'll have one chart list for Monday morning. And then the next chart list will be for Monday afternoon and Tuesday morning. Because when the market opens on Tuesday morning, anyone that reported, any of the companies that reported Monday evening or Tuesday morning are going to open for the first time since reporting earnings. Won't matter if it was the night before or that morning. And so that's the way we like to group them together. This time, my mistake, we just had them grouped all in one day. So the first one, when you pull it up, is going to include not only Monday before the open, but also Monday after the close. And then Tuesdays, if you pull up the next one, will include both Tuesday morning and Tuesday afternoon. So we're looking at maybe trying to rectify this. And maybe by tomorrow morning, I'll have that for you, where you can re-download them so that you have it broken out the right way. But right now, if you've downloaded these over the last couple of days, then you've got it set up. So you just got to be a little careful with it. Anyhow, the beauty of these, though, once you set them up in your account, is if you pull them up in summary form, you'll have all of the companies the day that they report. right at the opening bell, you can see how companies are reacting to their earnings reports. All of them simultaneously. So here, again, for instance, this is April 19th. So this is going to be morning and afternoon. So some of these tomorrow at 9:30 will have reported. Some of them still won't report until the end of the day. But again, that's what I'm talking about. We'll try to get that corrected. But going forward, you will have chart lists, upcoming earnings chart list of all the companies that open up that morning that have reported since the prior day's close, all in one chart list. I think it's a really cool feature. And again, this is part of, what we offer as part of just being in our EarningsBeats Digest community. Now we do offer a little bit more for our members. One of the things that we do is we have what's called an upcoming earnings relative strength chart list. So at the beginning of the week, I put together an upcoming earnings relative strength chart list that, and going forward, actually, I did this one. Matt Townsend, who works with me, will be doing them in the future. But what I've done is I've included every company that has a market cap over 1 billion that reports this week, Monday through Friday, all of them. And we'll be sending these out at the beginning of the week, so you have an idea of how they are looking on a relative basis to their peers. And I'll explain it a little bit more in just a minute. But all these companies are over $1 billion in market cap. All of these companies are liquid. I make sure that the volume is at least 200,000 shares per day. And then we have it lined up on a relative basis rather than an absolute basis. So for instance, I'll pull up Schwab here. And what you can see with Schwab, this is Schwab relative to the investment services group, which it's a part of. So what this is just telling us going into earnings is how favorable does a stock look relative to its peers as it's heading into earnings. Now, I mentioned earlier, I thought Schwab was one of the more disappointing reports. I thought that was one of the highlights from so far in earnings season. And you can see it here on this chart. It was actually uptrending relative to its peers, which tells me that Wall Street probably didn't have, catch much wind of this missed earnings. Or if they did, maybe they thought it wasn't as bad as it's turned out to be. But look at the relative weakness in Schwab today and the huge drop. So that's all part of this upcoming earnings relative strength. And the beauty of this is, if you do this at the beginning of the week and you look at it at the beginning of the week and you pull it up in summary form, you can then go back and say, well, give me the last 3 months and which companies have done poorly relative to their peers over the last 3 months and which ones have done well over the last 3 months. And you can get a sense for maybe which companies the Wall Street is maybe favoring. Just a very quick and dirty little way of checking it out. Anyway, I think this is really cool. Now, one more thing I wanted to show you, because remember we talked about all of those industry groups on a relative basis that were looking good. Remember, I told you hotels I thought looked pretty good. Automobiles look pretty good. I didn't go through all of the industry groups, but defense really looks good right now to me. Heavy construction, commercial vehicles, property casualty, insurance brokers, anything that I thought looked good, I put in the scan. And all the way down through gold mining, general mining, steel, aluminum, all of the energy groups that look good, the utilities, the consumer staples, real estate, everything. And so I put all the industry groups in here. Of the 104, I think there are 29 of them that I put in here that I think are really strong industry groups. And then what I did is I took all of the upcoming earnings chart lists and I said, give me all the stocks that are in one of these 29 groups and also in one of these 5 chart lists, upcoming earnings. And so what this does is it goes through and highlights all of the earnings coming up this week in the strong industry groups. And when I ran that scan of the 135 stocks that are listed on these 5 upcoming earnings chart lists, 34 of them are in these strong industry groups. And here they are. Now, I literally just did this right before the show. I ran that scan. I then dropped them into a chart list. And then I went back because I didn't have the dates or the times. And all I did is I put 419. So 419, of course, is April 19th, which is tomorrow. And then if they reported in the morning, I put AM. And if they report in the afternoon, 419, I put PM. And so it'll basically sort this in chronological order of how they're going to be reporting this week. Now, the other thing you can do here is I can set this up in summary form, and I can add columns for the sector and the industry group. And so now you can see these are all industry groups that I talked about or that I've looked at and feel that, we've got some really nice, nice stocks within some nice groups. Well, actually, the stocks themselves don't have to be nice. They just have to be within the groups that I selected. So some of these might be really good and some of them might not be. We can go back and pretty much figure it out by just saying, okay, give me 3 months. Which stocks have done well over the last 3 months? And I think you can kind of tell steel stocks, aluminum stocks, oil stocks, gold, defense. You can kind of get a sense. But then down here at the bottom, there's still in some good groups, you've got some bad stocks. HTH is in property casualty insurance, which has been a really good group of late, but the stock itself is not. But notice most of these have been, if you look up here, most of these have been good stocks because they're in good groups. And it's more been an exception to the rule where stocks have not done well over the last 3 months. I don't know where the S&P 500 is, but I would say the S&P 500 over the last 3 months since mid-January, it's probably down 5%, 7%, 4%, I don't know, something like that. So there's probably this cutoff right about in here. So maybe 4 of the 34 stocks on this list have underperformed the S&P 500, and probably the other 30 have outperformed. So, but these are in areas that have been doing well. So it makes sense that these stocks would be performing well. But there's a lot of different things you can do with this information once you have it, just to manipulate it over at Stock Charts to do whatever it is that you want to do with this information. We provide the chart list. We do a lot of research for our members and for our EB Digest community, a lot more for our members. If you really want to be impressed with research, just come on board for a 30-day trial. I think you'll see an unbelievable amount of research. But this is just to help everyone heading into earnings season, just to organize things, to get these chart lists together. All right, so I want to try and wrap this up in the next 10 minutes or so. So let's talk about the strong earnings that I think are going to be coming out. So I went through and just kind of looked at some of the charts that I thought were really interesting. These charts that I'm going to bring you up right now, there's probably about 7 of them. Most of them are in different sectors. I tried to pick one from each sector. I think I might have a duplicate in energy. But I think of these next 7 stocks I'm going to show you, 6 different sectors are represented. So these are some of the better stocks I'm seeing in a number of different sectors. So first, Liberty Oilfield Services. You can see the stock just went up to 18 today and broke above this June high. AD line's been strengthening now for about the last 5 months. Relative strength right here, relative to its peer group, just broke to about a 6-month high. So it looks like it is setting up for potentially a good report. And again, it's in a strong area, so I would expect strong reports in these areas. So LBRT, I think, looks very bullish, and that's in the energy space. RCI, now this is one in technology. Look at Rogers Communications. It's in the mobile communications group, but it's been going straight up. Look at the AD line going up, and look at relative strength versus its peer group, and then versus the S&P 500. And its industry group is not that bad relative to the S&P this year. It's actually up for the year. So this is one of those few areas within technology where we're seeing at least a little bit of relative strength. So RCI is one that I would be looking at as possibly a solid return or solid report. Halliburton, this is another energy. So this is the duplicate energy. They report tomorrow morning. I think you're going to get a blowout number. AD line's awesome. We've been moving straight up. Volume trends have been very strong on this way to move to the upside. And then look at the relative strength. This is a poster child of what I like my charts to look like of companies that I own. Your industry group's going up. The stock is outperforming its industry group. It's outperforming the S&P, and the industry group is outperforming the S&P. When all of these are lining up bullishly, I'd be shocked if they come out with a report that is disappointing. I would be shocked. I think they're going to beat on the top line. I think they're going to beat on the bottom line. Wouldn't surprise me if they raised. Maybe we see a gap up, and then maybe we get a little sell on the news, and that could set up for a possible entry. That's what I would be looking for. NUE, this is Nucor. So this is in materials area, steel stock. AD line moving up, price action moving up, good volume trends. And once again, everything moving up from left to right here in 2022. Nice looking chart. So again, that's Nucor. REXR, let's move into real estate. Rexford Industrial Realty. It's in the industrial and office REITs area. AD line just recently near about an 8-month high. Overall price action pretty good. The group hasn't quite broken out. This isn't as good as the other one, but for the most part, you can see trending up from left to right. So I'd say overall, pretty nice looking chart in the real estate space. Next up, Tesla. Now, Tesla still got a strong AD. It's made a big move at the end of March, came back down here in the first half of April. But on a relative basis, look at Tesla relative to the autos. Autos, as I mentioned earlier, still show some strength relative to the S&P 500. If consumer discretionary is going to get a lift from something, I would think it would be Tesla coming up with earnings. I think they report on Wednesday after the bell, I believe. Double check that. But yeah, Tesla looks pretty good to me. And then, and that's in consumer discretionary. And then ANTM is in the healthcare area. This is Anthem. AD line strong, price action strong. Look at the relative strength, everything moving up left to right. Anthem very strong heading into earnings. Now, some other ones I'm going to give you also were appealing to me, but they've got something wrong with them. Mostly it's their peer group. Some of these are banks. BKU, Bank United, AD line looks pretty good. The price action, you look at it and you say, well, it's not really going anywhere, but remember, it's in the bank group. Sideways in the banks right now is off the charts strong on a relative basis. Look at the relative strength over the last 2 months, straight up. And it's because it's been going sideways while most banks are just getting clobbered to the downside. We've had look at the bank index going down right here. And yet outside of this move from here to here, banks kept going down. But look, from here to here, we're actually higher. That's why we're getting this relative strength boost. So if you're a fan of the banks, you really want to see these stocks that are leading come out with some good news. So this is one of those that I think in the banking area that could come out with some decent news. We'll see. CCI, Crown Castle. It's okay. The AD line started trying to strengthen off of this low. It's been going up with price. The group that it's in, diversified REITs, has been strengthening on an absolute basis. And you can see generally we're trying to move up here on the right-hand side of the chart in terms of relative strength. So it's not great, but it's certainly good. And it is in the real estate area, which has been strong. So CCI, I think, warranted at least a mention here. EWBC, this is another bank. Not going to spend a lot of time. AD line's been moving up. Price action, even though, kind of been coming down here last 2 months, overall sideways, which has resulted in some uptrend versus the banking group. CBSH, another bank. Commerce Bank shares, again, sideways action. Look at the relative strength. So these are banks that I would be very carefully watching. If they roll over with their earnings, then it's probably not good for most of the banks. Prologis, PLD, another one in the industrial and office REIT area. AD line just broke to a new 52-week high. Price action just broke to a 52-week high. And when you look at the relative strength here, looking pretty good. So PLD in that real estate area, looking pretty strong. Last one I have for you here is CMA, Comerica. Another one in the banking area. This just had a double top at all-time highs. I'm pretty sure that was all-time highs for CMA. Definitely you can see 52-week highs. And that occurred this year when banks were already starting to put in lower lows and lower highs. Look at the relative strength. It's been consistently strong. I could argue this is probably the best bank or one of the best banks heading into earnings report or heading into their respective earnings report. So let's see what CMA comes up with. But this is a bank that, again, if you're in banks, you really want to see this company come through because Wall Street's been moving into it on a relative basis. How about some of the worst performers? Well, I'm going to go through these quickly because I want to wrap up here in about 3 minutes. But Carvana, price action, horrible. AD line a month ago was at a 52-week low. It looks like it's rolling over again. Look at the relative strength. It's in the specialty retail space, which has just been awful. Took a big hit December and January, and it's just been sitting down here near a 52-week relative low. Bad stock in a bad group. Look at all the volume coming in on the move down. I mean, it just has a really bad look to it. CVNE, not good. Safe. This is safety, income, and growth. This is in real estate, specialty retail. Specialty REIT. And you can see going down. The overall group, look at the group going up here over the last 6 weeks. And now you've got a stock in the group that's been going down. So money's been rotating into the group, and that still isn't helping the stock. Look at the big volume, the selling, the AD line back down, 52-week low. What's going on here? We're probably going to find out with an earnings report that's probably not going to be very good. HTH, this is Hilltop Holdings. This is in the insurance area. Look at insurance. Breaking out in March to new highs, heading up to new highs. Look at HTH, breaking to new lows. It's in a great group. And yet, look at the distribution taking place. Something's going on here. Wouldn't want to be in it. MKTX, this is in the investment services area. Investment services has not broken down yet below its March low. MKTX has just been horrible. And look at all the volume coming in. I don't know what's going on. I haven't been following the story. Maybe there's a story out there. AD is just falling off a cliff. Lots of folks bailing on this stock. I wouldn't hold it into earnings, that's for sure. WAL, Western Alliance Bancorp. This is actually one of the worst performing banks. AD line, horrific. Price action from 125 down to 75. So it has been dropping relative to the bank index. And of course, banks have been one of the worst areas of the market. So you have one of the worst stocks in one of the worst areas. Can't feel very good going into earnings with that scenario. Netflix, the big gap down that we saw back in January. I mean, I'm seeing like a bear flag here in this chart, moving down and then more sideways action. We could get a gap down, another breakdown on Netflix. If there's one saving grace here, it's the fact that we've seen some decent AD. But honestly, if you look at it, most of it is just a couple of different days in here where we had good volume and the AD line shot up. And ever since we started trending back down, I think the AD line looks like it's starting to trend back down as well. So I'm not sure how much positive I would put in there, because Netflix relative to internet stocks is horrible, and internet is horrible versus the S&P. So it doesn't look to me like we're going to get any good news coming out of Netflix. And of course, that's one of your FANG stocks. Is that going to really, if they come out with a bad report, what's that going to do to the NASDAQ? How's the NASDAQ going to react? You got to at least be nervous heading into Netflix's report. PPG. And I've only got 3 more here, and then we're going to wrap up. PPG, you got the AD line, horrible. It was moving to new lows even when price was trying to move higher. And then finally, we just caved in. Look at all the volume coming in on this selling. We got a little bounce. Volume started declining on the move up. Now we're rolling back over again. Relative to its peer group in the materials commodity area, you can see down, setting new 52-week relative low, even though the group overall has been moving up. That's helped this stock. The group has moved up, and that's helping to lift a stock that is a very, very poor performer. So with earnings, we'll probably find out why. Lam Research, going down the last 3 months. It's in the semiconductor space. You can see right there on the AD line, setting a new low, a low that we haven't seen since all the way back in April of 2021. Relative to the semiconductor group, it's very poor, and semis continue to sell off on a relative basis. So you got one of the worst stocks in one of the worst groups. Can't be excited there. Same goes for HCSG, Healthcare Services Group. Here, look at the healthcare providers. That's its industry group. It's been going up for 8 months, 7 months, whatever. Look at healthcare providers relative to the S&P 500, one of the strongest groups. And look at this stock relative to its peers. Horrible. If the stock can't go up when money is rotating into its peer group, when's it going to go up? And why is it not participating? Is this a bottoming head and shoulder pattern? Maybe we get good news. If there's good news coming, they haven't told Wall Street, though. A breakout above 19, that could be a breakout of this bottoming head and shoulder pattern. But you don't get a confirming breakout until you actually it's not seeing the pattern that's important. It's breaking out. So HCSG is one that I would be careful heading into earnings. So those are that's really what I wanted to go over. So this is the preview. We'll have much the same next week, but obviously we'll have a lot more in our rear view mirror. So I'll have more companies to talk about next week. Next week's event, by the way, Q1 earnings, is a member only event. So if you like this, if you want to see more of this, we have a 30-day free trial. And so you can come on board. You'd have to give your credit card so we can get you set up in our system, but there'll be no charge until the end of your trial period. And we will reach out to you to tell you that your trial period is ending. We're not going to just wait and quietly charge you after 30 days and hope you forget. We don't want you to be a member of EarningsBeats if it's not something that makes sense for you. So anyway, check us out, though, if you like tonight. We'll do this again a week from now with a lot more companies to discuss. All right. I don't know. Do we have some questions?
We do have a couple of questions. So the first question pertaining to ChartLists. Obviously, all of our upcoming earnings chart lists are already on the website for this week for members to download. Are there any specific chart lists from tonight that you'll be posting, like that Strong Group's upcoming earnings chart list?
Well, the big thing was that I was just trying to show you how you can use the scan engine, combine it with the chart lists. I mean, we've already, by the time I could even get this ready, I mean, remember, we have another event tomorrow with the draft. So I don't know that I could get it ready probably before Wednesday. At that point, we're already two days in. So I probably won't make that available. What I could do, though, at some point is I can give you the scan, Aaron, and we can have that set up in the somewhere on our website, maybe on our scanning page for anybody who wants to use it against future upcoming earnings list. So for instance, that scan, all you'd have to do is once we give you the new earnings and upcoming earnings and you put that into your account, you could still use these same groups. I don't think we're going to see a whole lot of change in relative strength. And then what you would do is just simply go in here, delete this. And then down at the bottom, all you do is you go in and you select your chart lists. So wherever you stored it in your account, just go and pick up those 5 chart lists, set them up. Now, when you first add them up here, you'll see what happens. Let me just show you how you would do that. So if I did, the first one here, add it, and then I did the second one, I'm not going to do them all, but I want to show you because you do have to make a couple of changes. So what you're doing is you're saying, okay, give me any of them, any stock that is in any of these groups, and give me a stock that is in any of these chart lists. Well, right now it says, and this chart list and this chart list. Well, there's no stock that's going to be in both these 2 chart lists because they're different days earnings. They're all different stocks. So what you have to remember to do is you've got to put in another bracket here. And at the end, now I'm just doing 2 chart lists, but after you put 5 chart lists in, you'll do it at the end of the 5th chart list. Make sure you put those brackets in. And then between the first and the second, you have to change and to or. And then the same thing for any others going down. So for instance, just today and tomorrow, I could now run the scan. And you can see there are 6 of them that come up between those 2 days. So you just got to remember to do those couple of things. But, once you have that scan, you can now, and the other thing is you might look at this scan and you might say, well, I'm not interested in anything relating to utilities. I'm not going to trade utilities. I'm not interested in real estate. So you just get rid of those and you can still run it. And then you can save your scan however you set it up right here. And then the only thing is maybe every couple of weeks, probably you need to go back and take a look at the industry group relative strength chart list just to make sure that the names are still the same.
Okay, so what we'll do, we can publish the syntax on the page that the webinar gets posted to so that everyone has access to it. And I'll timestamp this in the recording so that if you want to refer to this later, you can easily find the segment of the webinar.
Awesome. Yeah, that's a good idea.
Okay, next question. Do you have any comments on the performance from FANG stocks? I know you talked about Netflix earlier. I'm not sure if you covered the others.
Well, one thing you can do is if you look at like IWF, that's the iShares Russell 1000 Growth ETF. This is going to have a number of the FANG stocks in it. It's a lot of the high growth, large cap growth stocks. And so this is a pretty good indication of what we're seeing right now. We've got some of them like Apple that's performed a little bit better than others. And then we have some like Facebook that has just been horrible. Netflix been horrible. So, they're all over the place. But I would say overall, I don't like the FANG stocks right now. I think that they'll be great buys at some point later this summer. I just think you're going to have patience. And we could bottom at any point. I mean, one thing I did point out to our members is that when you look at the S&P 500, it looks like things are rolling over, but you do also have to pay attention. And I see it here on the IWF, which is why I'm going to bring it up. If we went back, let's say 2 years, you can see this huge move to the upside. I mean, what we potentially could have here is an inverse head and shoulder continuation pattern. Left shoulder, neckline, head, right side of the neckline, and then right shoulder, which is pretty symmetrical with the left shoulder right now. So, I mean, you can make the bullish argument that, hey, we're in a continuation pattern and we're just going to explode higher from here. And if I wasn't seeing other bearish signs, I'd probably be talking about that more. But I don't think in this right shoulder, we would be seeing defense stocks leading again. I think we would start to see money rotating into some of those aggressive areas, and we're just not seeing it. So I don't think this is the pattern that is going to execute back to the upside. Maybe it is. I'm certainly aware of it. I'm watching it, but I just don't think it's going to happen. I think we've rolled back over again. You can see that the PPO on the IWF now has turned negative again. That shouldn't happen in this kind of an environment, in a bullish environment. So I think we go lower again. I'm thinking FANG stocks still have some downside.
Okay, last question. QCOM will be reporting soon. I recall they had a major gap up in the last earnings season. Understanding that you aren't a registered investment advisor and can't provide advice, is buying prior to earnings a reasonable risk?
Well, thanks first for that full disclosure, which is absolutely accurate. No one at EarningsBeats. EarningsBeats is not a registered investment advisor, and I'm not. No one at EarningsBeats is a registered investment advisor. So we cannot provide advice. And I know there's a lot of trading services that are out there, buy this, sell that, buy this, sell that. I don't think that's appropriate. And that's not what we do. We try to educate, we provide research, we provide guidance. I'll give you my opinion. I do that all the time. But when you go to invest your money, you have to understand I'm not managing anyone's money. I don't have any clue as to what would be appropriate for each of our members. Everybody's different. Everybody's got different risk tolerance. Everybody's got different financial goals. In order to really, provide some advice for someone, you have to know more about what their situation is. And so, yeah, we don't provide any advice. So thanks for that. I do try to mention that in our webinars whenever we do them. Looking at Qualcomm, I think there's some bullishness here on the chart. You are back at this gap support area. That's a positive. The problem I see with Qualcomm is just the problem I see with the overall market. I still view Qualcomm, it's maybe a little bit more value oriented, but I still think of it as a growth stock. Maybe a little bit safer growth stock than some, but I think that it's probably going to go back down and test these lows that we saw back in May and October. If I'm right about the market, I don't think Qualcomm's going to go against the market and take off. But telecommunications equipment companies there are some out there that are doing well. So I'm not going to rule it out totally. I just am, for the most part, on the long side, staying away from many technology and consumer discretionary names and communication services, just because Wall Street's staying away from them. And that's where I'm getting my cues. I don't care what they're saying on CNBC, but I do care about where they're putting their money and where they're not putting their money. And so Qualcomm to me just looks like it's probably going to continue to roll over. I think if it could get back through its 20-day moving average, at least in the short term, it would begin to right the ship a little bit. But I just think the market goes lower, and some of these areas of more aggressiveness are going to have some issues in coming weeks and months. So I personally would not jump into Qualcomm. That's just my opinion.
That's all we have. So feel free to wrap up the session.
All right. Awesome. Again, thank you to everybody for coming in. I hope if you're new to EarningsBeats and maybe new to the EB Digest, that you see the value in being a community member. And for those of you that are already members at EarningsBeats, we certainly thank you for your support. That's what keeps us, here doing these things and doing these webinars and all the work that we do and all the research and guidance and so forth that we provide. So thanks again for coming in. Next week, we will have Q1 earnings, but that will be a little bit more comprehensive because we'll have a lot more companies that will have reported and a lot more coming up to report. So, and we'll have a lot more of a report card on as far as how these earnings reactions are coming out. So a lot of good stuff for next Monday's event as well. And also tomorrow, we're having our draft for our model ETF, which has outperformed the S&P by probably 3 or 4 percentage points. I think we might have underperformed a little bit today, so we might have given a little of it back. But after tomorrow, we're going to be swapping out the old and in with the new for our model ETF portfolio and all the various ETFs that we include. And we'll also be coming out with a strong ETF chart list that should be out in the morning, along with a new ETF analyzer spreadsheet. So all of that for any of our members. And some of that is available to our annual members. But anyway, the webinar itself is for all of our paid members or trial members. So check us out. Take us up on that 30-day free trial. That's it for tonight. Appreciate you stopping by. Take care and happy trading.